Hello, everybody. This is Dave Gilreath from Sheaff Brock Investment Advisors. Remember, we're the firm that uses innovative portfolios for intelligent investors like you. Today, we're going to talk about the return to normalcy. It's been several years since we've had a normal market or economy or even political situation. And it seems to me we're going to be approaching, anyway, a return to normalcy. So I'd like to share a few slides with you today and just talk about why we think this is the case. So let me rewind a little bit. A little over 3 years ago, 3.25 or so years ago, we did a video in December of 2020 about the Roaring '20s and about why we thought that the 2020s were going to be quite good, even though this was, 9 months after the pandemic, and things were certainly up in the air at that point. And we showed this slide that talked about the Dow Jones Industrial Average and why we thought it was going to double and go to 50,000. And I based it on this chart that showed in 1981, when I started in this business, the Dow was at 875, and then you can see it doubled to 1750, and then doubled to 3,500, to 7,000, 14,000, 28,000. So it doubled 5 times. And our belief was, hey, the economy is still pretty good in this country, and we're going to see 56,000 one of these days. So we just rounded it to 50,000 and said, we think it's going to go to 50,000. So in December of 2020, there on the far right side, we made that prediction. Now, we've done this multiple times. Like in 2010, when the Dow was at 10,000, we said we thought it was going to go to 20,000 in 10 years, and it beat that by a long shot. But so we've made these kind of projections in the past. And so right now we're going to stick with the 50,000 by 2027. So we've got another, 3 years or so, 3.5 years left for us to hit 50. Right now, the Dow is about 38, 39,000. So we're closing in on 40. So we feel pretty comfortable with that. But we've had several years of dislocation, I would call it, and it was really caused by the pandemic. And the Fed did all kinds of things they'd never done. They'd never bought corporate bonds or mortgage backs, and they bought those, and the money supply exploded. They printed money, and there was huge government spending for the last several years, and it's continuing even right now. Interest rates collapsed, which was a good thing. I mean, people could buy cars for cheap, and mortgages were very cheap. And now interest rates have gone back up, and we've had 2 bear markets in there. We had 2020 and 2022, which is unusual. Normally, they're only every 5-6 years. We have big cities that the downtowns just have all kinds of problems. We had trade wars and supply chain problems, although people could work from home, which was a good thing for a lot of people. And in all of this, even life expectancy went down in this country, maybe for the first time since maybe the flu pandemic in 2018 or in 1918, I have no idea. But right now, things are getting back to normal. And we want to talk, first of all, about basically about interest rates. There's a lot of talk now about the Fed. When are they going to cut rates, if they're going to cut rates? And if most people don't think they're going to raise them anymore, but nobody knows when they're going to cut. And if the economic numbers come out that the economy is too hot, the market goes down because the Fed's not going to raise or cut rates until later on. But some people think that this is just a screenshot of news just in the last couple of days of all these different stories about when they're going to cut and how much they're going to cut, and nobody really knows. But the one thing we do know is when they do cut, if you're patient, it works out good for the stock market for the most part. So the first set of numbers on the left here are when they stop raising rates, what has happened to the stock market. And you can see in the last time was at the bottom there in July of 2023, that was the last rate hike in this cycle. And since then, the market's gone up. But generally speaking, the markets have gone up, not every time, but for the most part, they have. And then on the other side, on the right-hand side, is the start of the rate cuts. Once they start cutting rates, which who knows, maybe that's March, maybe it's May, maybe June, July, who knows, we don't know. But whenever that happens, if you push it out 6 months, then generally speaking, the market has been higher. It wasn't twice, that was in 01 and 07, which those were the beginnings of big recessions. So the Fed cuts rates for different reasons. There's really three reasons. They cut it because of a panic, like in 1987 or during the pandemic. They cut rates in a panic situation, or there's a recession, like in 01, 07 recessions, or the savings and loan crisis in the early 90s. But sometimes it's just normalizing. They're normalizing rates. And my contention is this time is more of a normalization like it was in 84, 95, et cetera. And so when that happens, this shows every rate cut since 1984, the last 10 times they've done it, and what's happened to the S&P 500 1 month, 3 months, 6 months, 12 months out. And you can see basically the 12 months out, the far right-hand column, they've gone up every time except twice, and that was again during the recessions. So, but 80% of the time, the S&P 500 has gone up once they've started cutting rates, and you go out 12 months. The first month or two or three, it's anybody's guess. It's kind of a coin flip as to whether the stock market will react favorably. But if you go out 12 months, 8 out of 10 times it has. And now if you break it down by the three different types, the normalization, the panic, or the recession, go down to the bottom, the recession cut, market's gone down most of the time, and it's gone down on average double digits. During the panic cuts, initially the market doesn't do very well, but after a year, it has generally done quite well. And the normalization cuts, if you go out 12 months, the market's gone up low double digits, which is good. So that's a good thing. The Fed cutting rates this year should be good for the stock market. But the other thing that I think is a good thing for the stock market is the fact that we had a positive January. The S&P 500 went up 1.6% in January, and this is a chart that shows when January is good, the orange line, generally speaking, on average, the market has done quite well. The blue line is when January is negative. It hasn't always gone down, but on average, it's been a weak year. So between the rate cuts that are probably coming later this year and the fact that January is good, I would say 2024 should end up in a pretty good space for the stock market, a decent year for investors. Thanks for watching. We'll be back out with you again with another update. Thanks.